Over time, markets work, but over time. I don't want to seem like a doomster. I think that what we face is easily survivable. But I think the next 10 years are going to be much less benign than the last 40 have been.
In this video, Rick Rule, the legendary investor and speculator, sheds light on the upcoming challenges and unprecedented volatility that investors will face in the next decade. Brace yourself as Rick shares his insights on the economy, commodities, and the impact of technology. He discusses the potential scarcity of resources and the ways in which markets might respond. Join us as we delve into this captivating conversation with Rick Rule.
And I think that in addition to facing real risk, that we're going to face volatility of a type that most investors haven't experienced. What can happen in a recession is that sustaining capital investment can go away, or it can be met by increasing geopolitical tensions. That means that even if supplies are available, they aren't available to certain nations or societies. One of the things that's happening is that the globalization that the world has enjoyed, I realize not everyone has enjoyed it, for the last 40 years would appear to be over. And it would appear that both investment and consumption are increasingly being constrained politically, which could, as you suggest, exacerbate these supply issues. Over time, markets work, but over time. One interesting example of that is the investments that we've made in alternative energy in anticipation of the end of oil. But many of your listeners will be surprised to know that humans have invested now almost 5 trillion US dollars in alternative energies over 40 years. And we've reduced the market share of fossil fuels from 82% all the way down to 81%. We've had a 1% decrease in the market share of fossil fuels with the investment of almost $5 trillion over 40 years. So markets work, but markets are messy and they take time. I think the world is going to need more of all kinds of energy and all kinds of resources. Solar, yep, but not in Germany where the sun doesn't shine. Wind, yep, but not in places where the wind doesn't blow. Coal, I know people hate to say it, but the largest year in history for coal demand was 2022, and 2023 is going to be bigger. Nuclear, yep. Oil and gas, yep. Hydro, yep. Batteries, yep. Room for everybody. 1 billion people on Earth. 1 billion people have no access to electricity. Another 2 billion people on Earth have access to intermittent and unaffordable electricity. And those societies where populations are growing faster are precisely the societies that are underserved with regards to meeting their citizens' material needs. These trends are absolutely inevitable trends. We've done a great job as a species in the last 40 years, lifting up the poorest of the poor, taking people from desperately poor and starving to merely poor. That doesn't mean that more doesn't need to be done. It does. And that requires more energy sources of all types. We will offer up a paradigm around the way the world is rather than the way that the big thinkers would like you to believe. We will offer up the fact that the world is growing and that providing for the material needs of humanity is an important ESG consideration, which means that we'll have wonderful big picture thinkers, but not the kind of big picture thinkers that you would see on CBC or CNBC. Contrarian point of view that is more arithmetically oriented than narrative oriented. Importantly, if you come to agree with that point of view, if, as an example, the fact that the market share of fossil fuels has fallen by only 1% over the last 40 years comes to you as being something that's worthy of consideration, we're going to have a lot of analysts and portfolio managers at the conference who have been invested in natural resources, interested in natural resources for 30 or 40 years. Not people who learned to spell lithium 3 years ago, but rather people who have made their living investing in money in natural resources through thick and thin for a long time. The theme 20 years ago was the emergence and the urbanization of China. I would argue that when Deng Xiaoping said to be rich is glorious and began the process of urbanizing China, taking 450 million people out of desperate poverty and moving them into this century, that a couple things happened. One, China became structurally much richer as they became marginally less free. At the same time that consumers in the West met 500 million competitors for material goods. I hope, frankly, for a whole bunch of reasons, that the Chinese success in increasing the material well-being of its citizenry comes to be matched or at least approached by India, by Indonesia, by Nigeria, by Ethiopia. The lifting up of the bottom third of humankind is the greatest challenge that humanity faces, and it's also the area of greatest promise for natural resources. In the West, we think of battery materials around what will Tesla's market share look like in 5 years. That's the icing on the cake. Providing basic electricity to 1 billion people and then furnishing their lives so that they can take advantage of the electricity. Increasing per capita consumption of natural resources over billions of capitas is the real story. The idea that the purveyors of the world's reserve currency have $130 trillion in net present value of recourse liabilities, and they attempt to solve that with a budget that's in deficit, $2 trillion a year. I think that's an interesting one. But I think the most important one, and I don't want to be, I don't want to come across like some sort of granola eater, but I think the phrase that people need to keep in mind is humanity. We need to keep in mind that while we've done a wonderful job increasing the material well-being of the bottom third of humanity, that there is still a job to do. If we allow those people, if we get out of those people's way, they will become more rich and they will want to increase their material standards of living. So for resource investors, at least, I think humanity is a more important phrase than solvency. For other investors, they need to pay real attention to solvency. The paradox that our individual creativity and tenacity so far has been enough to finance our collective stupidity is a wonderful thing, but it's something that scares me on a going forward basis. I think that we lived through a time of 40 years, 1982 to 2022, of very benign economic climates, declining nominal, declining real interest rates, relative peace on a global basis, the impact of technology on societies and also people. Again, I don't want to sound like an ESG warrior, but inclusion in the workforce, and the breakdown for a while of economic nationalism, the increase in global trade. I think for the time being, all those things are over. I don't want to seem like a doomster. I think that what we face is easily survivable. But I think the next 10 years are going to be much less benign than the last 40 have been. And I think that in addition to facing real risk, that we're going to face volatility of a type that most investors haven't experienced. I think the most important near-term change has been the the rise in at least nominal interest rates. We had a climate where both debt and equity were, at least by conventional measures, at sub-zero levels in real terms. The fact that investors could borrow money for rates that were very cheap relative to the deterioration of the purchasing power of their currency. And thus, as an example, real estate investors could lock in 30-year fixed mortgages where their cost of capital was fixed for 30 years, but they could raise the rent by 3.5% or 4% a year compounding. Their return on capital employed increases while their cost of capital decreased. And of course, the cap rates responded well too. I think that period's over for a while. And I think that people are going to have to adapt to the fact that a whole bunch of circumstances are going to be more challenging. Of course, there will be great opportunities in all of this, but your actions are going to have to be different from the way your actions were. Let's look as an example at the impact of the banking industry on declining interest rates. For 40 years, the banks were able to lend long and borrow short. They were able to have average durations in their portfolio of 6 or 7 or 8 years, and they funded these with very cheap overnight now accounts. When the interest rates rose, two ugly things happened. The yield stream in their long-dated assets fell because the interest rates rose on competing instruments. So the value of their portfolio fell at the same time that the cost of funding it in the overnight and now deposits rose. We've seen this before. It blew up the U.S. savings and loan industry once before. But this whole conundrum of things changing, of people's perception being set by the last 40 years, when confronted with a new reality that's very different, has had real impacts on the market. I don't think that behavior that has been taught over 40 years in a narrative that was created by 40 years of benign times has fully been appreciated by any of the constituents in society. I think the banks are unprepared. I think the government is unprepared. I think the voters are unprepared. I think savers are unprepared. I think borrowers are unprepared. I think that they will adjust, but I think that adjustment is going to be, to put it mildly, interesting.